Hello everyone, welcome to Dikshant classes. Today I am going to teach about the one by one accounting concepts. The first concept is the business entity concept. According to this concept, the owner of a business must be separated from the business and it must be separated from the monetary transaction that are done during the operation of business. The concept assumes that accounting purposes the business enterprises and its owners are the two separate entities. Thus, the business and the personal transaction of owners are the separate. For example, if the owner invests in the business, then record as the liability of the business to the owners. Similarly, when the owner take away cash goods from the business from personal use, then it is not treated as business expenses. Thus, the accounting records are made in the books of account from the point of view of the business unit, not from the point of view of owners. Separate entity concept already existed legally in a joint stock company. Even in the sole proprietor and the partnership firm, from the concept of separate entity concept, through does not legally exist. It is presumed to be exist for the accounting treatment. This concept has now been extended for the various divisions of the firm in order to ascertain the result each division separately. It means that this concept is extended for the various divisions of firms in order to ascertain the results of the each division separately. Separate entity concept has given birth to the center of the responsibility accounting for determining the operational result of each responsibility center. Next is going concern concept. According to this concept, the underlying idea of that the business would continue forever. Person come and go, but business will be continued its operation till it is not ordered to close by the court. And accounting transactions are recorded from the point of view of the business. On accounts, the concept accounting does not consider the market value of the fixed assets or force value of assets if business would be liquidated for the preparing the balance sheet. Depreciation is charged on the original cost of the fixed asset based on the accepted line. It means that the business is following the straight line method, then it should be follow the straight line method. If the business will follow the diminishing balancing method, the depreciation should follow diminishing balancing method. When the one method is decided, it should be continuing on. It means that at the time of preparing the final accounts of the business, we should take into consideration of outstanding expenses which is outstanding, which is not paid by the business firm, and prepaid expenses are the expenses which are paid in advance, and the presumption of the businesses will continue in future too. It is to be noted that going concern does not imply permanent continuation of the enterprise indefinitely, and moreover the concept applies to the business as a whole. Like assumes a business will continue trade for the foreseeable future. Allow cost revenue to be allocated to the future accounting periods. And it provide a more realistic values of the business assets. Allow fixed assets to be written off. You should be written off the fixed assets proportionally over the useful life of assets. Next is dual aspect concept. It means that every transaction has two effects, debit and credit. For example, a company has paid rent to 20,000 to the business to the landowners, and then it should be at 20,000 have the debit effect also. At the same time, it has also credit effect 20,000. It is based on double entry. Double entry accounting is based on the simple concept. Each party in the transactions will be receive something and something goods in return. In bookkeeping terms, what is received a debited, what is giving it a credited. The T account is a representation of the scale or the balance. Next is debit. Debit means what comes in. Credit what goes out. Debit what comes in means that assets, expenses, it comes under the debit. Where the credits include the liability, which is the liability of the business to paid of the expenses like EMI of the machinery, credit and liability. Capital, which is invest the capital and then they paid interest. Next is income. Next is father of accounting. Louis Pecoli is the father of the double entry accounting. Next is debit the receiver, credit the giver. It is a simple rules. Left side receiving debit, what comes in, and right side credit what goes out. This is the basic concept of accounting. As per this concept, every debit there is a corresponding credit. In other words, every transaction is recorded. Debit must be equal to the credit amount. It is known as double entry keeping. No transaction is complete without the double aspects. When a new business is started with a capital of 1 lakh and the position is expressed, capital equity is equal to cash assets, 1 lakh is equal to 1 lakh. The term asset denotes the resource owned by the businesses, and while the term equity denotes the various claims of the parties against those assets. For example, business asset purchase 50,000, assets account debit to cash account 50,000. Next is equities are two types, owner equities and outsider equity. Owner equity is the capital, is the claim of the owners against the assets of the business. Outsider equity or liability is the claim of the outsider such as creditor, loan provider like banks and financial institution, debentures holders against the assets of the company. Someone either owner or outsider has a claim against the assets of the business, so the value of the assets is equal to the total value of the capital and liability. Equity is equal to equity must be equal to the assets. Capital plus liability is equal to assets. Then it is the economic resources of the entity as in the economic resources of an entity is assets. Where equities are the claims of the creditors and owner of the businesses. Assets must be equal to liability. Assets is equal to liabilities plus owner equities. It can be calculated as asset is equal to liability plus owner equity. Next is the difference between debit and credit. Debit is a value of for a transaction, where credit is the source value of for a transaction. It is used to increase or decrease in the assets and expenses of the liabilities and incomes. Credit is used to expressing the increase or decrease in the liability and income of the assets expenses. The debit is the first account is recorded. Credit is recorded after the debit account forward to. It is always on the right side. It is always placed on the right side. T is always placed on the right side, where credit is always placed on the left side. Equation: assets is equal to equity plus it can be calculated. Equities can be calculated as asset is equal to liability plus equity. Also crediting one account. Asset is equal to liabilities plus equity is affected by debiting one account. Under the double entry system, debit alone cannot balance the whole transaction. Similarly, credit cannot balance the whole transaction. Similarly, credit cannot balance the whole transaction without the assistance of debit account. A cash increase, we will debit cash. A sales increases, we will credit the sales. That's all today's class. If you have any doubt, any query, you can put it in, you can comment in the comment section. I will surely make video. Thank you so much for listening carefully.